And we're live. So welcome everyone to the official launch event for our first ever receivables financing lending pool here at Maple Finance. We're excited about bringing real world assets natively on chain, expanding the use cases of our debt capital markets infrastructure, and furthering the adoption of stablecoins and digital payment rails. So I'm Quinn Thompson, lead capital markets and growth here at Maple, and I'm joined by CEO of AQRU, Phil Blows, who's managing and leading the new pool, as well as Tom De La Rue and Daryl Stein, who are the co-founders of Intero Capital Solutions, the inaugural borrower from this pool. So we're happy for everyone to be joining us today. We'll get to intros in a moment. But first, I just want to give a quick overview of our agenda and what we're going to cover. So in this session, we'll go through the team introductions, talk a bit more about the pool itself, hearing from Intero about the receivables financing business, and then do a deep dive into AQRU's role as pool delegate and their strategy going forward. We'll have some time at the end, about 10 minutes, to answer any questions. So in that bottom right box, please feel free to post any questions you might have in the question channel, and we'll get to them at the end. So on to the introductions. Take it away, Phil.
Thanks, Quinn. Yeah, my name's Phil Blows, founder of AQRU. AQRU is a UK publicly traded company, and the team really is, their background comes from traditional finance, but we're quite early into DeFi, so I've entered the space around 2017. And I think we've been dealing now with Maple for about a year, and we've been impressed with the platform. We've integrated into our system, and it's performed really well, and investors have loved it. So we're really excited now to actually be a more integral part of the system itself by being a delegate of the first real world financing pool, which is exciting. Also, we've, over the last 7 or so months, we've formed a great relationship with the guys over at Intero. And, we've been really impressed with just the level of professionalism and the track record that they've had. So, one thing that we were really keen to do at AQRU was to try and find a really solid yield solution for DeFi, because having been in it since 2017, we felt that having something that's underpinned by real world use cases is severely lacking in the space. And we think in Intero we've really found the team to do it. So yeah, excited to be here.
Thanks very much, Phil and Quinn. Sorry, I just jump in. Really, just echoing what Phil just said there. I'm delighted to be here. Daryl and I go back away. We've been working together for about 7 years. We formed Intero just on 2 years ago. Our background is really in receivables financing, multi-jurisdiction, multi-sector. We have transacted about $2 billion worth of receivables globally. And we really created Intero out of the collection of experiences that we had actually over a number of decades before that to target what we thought was some really compelling receivables opportunities that were emerging in the marketplace, not least on the back of global financial crisis and also COVID. And Daryl will talk a little bit more about that now.
Thanks, Tom. Hi, everyone. I'm Daryl, and along with Tom, co-founded Intero Capital Solutions roughly about 2 years ago. During 2022, we were looking to de-risk our business off the back of disruption to supply chains caused by COVID, as well as the general economic climate we found ourselves operating in. We worked to identify opportunities with unique risk and return profiles and became aware of various tax credits that seemed to fit our criteria, notably the employee retention tax credit, which we'll expand upon during the session. This allowed us to take the experience that we had accumulated over decades in the supply chain finance space around factoring and receivables and deploy it into tax credit programs. The team at Intero is small but experienced, and we are extremely passionate about our operational tax credit receivables funding program. We've worked tirelessly over the last couple of years and months with our partners to build an innovative and scalable advanced funding mechanism, which allows companies of all sizes across the US to benefit from early advance of the outstanding IRS tax credit receivables.
Thanks, guys. It's a real pleasure to have you join the Maple ecosystem, and we look forward to growing this pool. Over to you, Phil.
Thanks. Yeah, so this is just a little bit of a rundown of the of kind of the structure of the pool and why it was kind of set up. So yeah, tax receivables. We're going to go into more detail later as to what they actually are and more fundamentally. But what it is really, it's something that isn't correlated with the crypto markets, which is massively attractive for the average crypto investor because often you find that yields in other kind of areas drop as token incentive or the price of tokens drops with it. So having something that can retain a yield whilst markets are going up and down is quite attractive. And tax receivables themselves, this is one of the oldest sort of financial instruments, and bringing it online, so on chain even, is something that not really many people have done yet at all. And it's a $2 trillion market. So as Daryl said, it's massively scalable. So this is something that we're really excited to do. And we've aimed to begin with to sort of set up a pool that can scale to about 100 million or so, and we launched it 2 weeks ago. And we've already had about 5 million or so deposited, and all of that has been lent out already. So it's something that is already getting tried and tested. So it's exciting. One thing I would say is what we're targeting in terms of the return, obviously 9 to 10%. We're really trying to get towards that kind of double-digit return. Clearly, yields in the traditional finance space have gone up recently, so we think that this shows a really decent risk premium over what you get in, say, US Treasuries, for example. So getting a 10% return was really, really important, and we've structured something that allows us to be able to offer that. I think that's pretty much it. But I mean, we've got, in terms of the first loans, obviously, Intero is the borrower, and we'll go through the actual kind of flow of funds as we go. If you're looking to invest in the fund, then it's a 45-day sort of withdrawal cycle. The loans themselves that underlie it are for 6 months, and we can work through how that kind of liquidity profile works. But it's something that we were trying to balance, something that's attractive for companies like Intero, but allows us to also give decent liquidity to the lenders of the pool. So overall, it's something that we've worked very hard, and we're excited to get in the hands of everyday kind of lenders.
Thanks, Phil. Yeah, great overview. And Martin just posted a link to the Maple Finance application in the chat, so everyone can click that and go find the pools there. And so I think that's a good segue into a little bit on Maple 2.0. And both current and prospective lenders who are evaluating the pool can access all this information on the web app. There's a screen clip on the slide there, but it shows interest rates, fees, terms that comprise and underline the loans, the liquidity, upcoming repayments, upcoming lender withdrawals. And really, Maple 2.0's product updates have aimed to ensure proactive transparency from loan issuance or deposit to loan issuance and maturity by sharing all these key pieces of information and statistics about the underlying lending opportunities. So we're continuing to innovate, add features on a weekly basis, and really just want to provide the best-in-class lender experience. So while I have the floor, in speaking to Maple, it marks a pretty important moment in our evolution towards becoming a capital markets infrastructure and not just an uncollateralized DeFi lender. So obviously that's where we originally found product market fit across the board, and we'll continue to innovate on the market maker and uncollateralized and unsecured lending front as well. But it's important we diversify the business and grow into more use cases, bringing more adoption of on-chain lending. And so this pool highlights just that. Where in traditional lending, the loans themselves are assets held on the balance sheet of a bank or other lender, with record keeping done via a mix of manual plus the bank's internal private ledger. Maple's smart contract infrastructure brings those assets on chain themselves by tokenizing it, but also programming in the series of underlying cash flows, legal terms, and mechanics into separate smart contracts for each loan. And so in a world where USDC and stablecoins continue to embed more and more into the financial system and everyday life, the power of this technology really starts to shine. And so with that, I want to turn it over to Intero to just discuss a little bit more about their financing business, and then we'll get into the flow of funds after that.
Thanks, Quinn. I think, as as you've just said, and as Phil alluded to earlier, there's a massive opportunity here, both in terms of what digital liquidity can bring to this type of program, but also we're seeing on a daily basis a sort of kind of interest on the sort of traditional lending side and fiat, and Phil mentioned that this particular program we're looking at a sort of a midway point of about $100 million. We believe that's achievable, and we are pretty bullish from the point of view of the quality of this product, and I'll explain the program in a second, such that it should be able to go well north of 100 million, and we'll be able to blend probably across a number of entities some good traditional finance mechanisms as well as digital liquidity structures. I think just on the left of this slide is really the sort of the importance of what this is all about, because actually it's essentially about companies in the US, operating companies in the US that are trying to recover from a difficult 3 or 4 years through the global economic crisis which endures, and also on the back of COVID. So what the IRS has been doing, obviously for decades now, but increasingly so in some ways through the Inflation Reduction Act, is to put programs in place that strategically are geared to supplying liquidity into the US economy. It's hugely important for these companies because in some cases they really do depend on this. And in the case of the Employee Retention Credit Scheme, which is really the focus of, well, the initial focus of this pool, but this pool is actually geared to be able to attract investment across a number of tax credit programs. But with respect to the ERC, it's a huge opportunity to essentially reward companies across the US for retaining employees on payroll through the COVID period and through those very difficult times. You can see on the slides that ERC really applies to qualified wages through a number of quarters from the beginning of 2020 to 2021 inclusive. And it's being done in arrears. This program wasn't live during the time, so that essentially good, positive kind of commercial behavior from the point of view of keeping the economy going in those years of 2020 and 2021 is now really coming back into the spotlight for those companies, as they're now eligible to apply for these tax credits after the fact. And what we've got is really millions of companies across the US who are eligible to apply for these tax credits. And they are companies of varying sizes. They're across every sector and they're across every state. So it's a really very, very important tool in the US Treasury's armory, so to speak, in terms of creating that liquidity that their economy needs so badly. And Darryl will now go into the rationale for us creating this program and what the sort of value add is.
So one of the issues around all of this, given that it's a program to stimulate the economy, provide liquidity, is the issue that the IRS is currently facing with timelines. Their ability to essentially issue the refunds, put it back in the pocket of the applicants, the employers who were well behaved during the COVID period. At the moment, it's taking at least 3 to 4 months for these refunds to arrive. In some instances, 18 plus months, depending on the size of the credit and to an extent the complexity of the submission itself. The prognosis from what we've seen as well is that this backlog will continue for the foreseeable future, and in some instances continue to compound as more and more employers or entities become aware of the program and find that they do qualify for it. Addressing these lengthy delays in settling these tax refunds is the focus of the Intero ERC Advanced program. We look to address that gap in submission to refund. The claim size that we're currently advancing is averaging at about $350,000 per applicant, but it can be as much as $3 million depending on their specific circumstances. So the profile of the company, number of employees, etc. There's qualifying criteria around all of this. By providing the advance funding of these receivables to these companies, they are able to access this liquidity in a much more efficient mechanism. They can then take this cash, deploy it within their operations to grow their business without taking on additional debt because of the way that we've structured the program itself. This is not a loan structure to the applicants, it's a receivable purchase program. So it's quite a beneficial program to these applicants in that sense.
Yeah, that makes sense. Thanks, guys. And so in simple terms, lenders are lending into the pool. AQRU is managing and administering the Maple pool, which lends to Intero. And then you guys are advancing applicants, the funds sourced by qualified originators, and you taking receipt of the transaction settlements from the U.S. IRS as those assets sit in an escrow account.
Yes, exactly.
Yeah, exactly. Yeah. So if we go to the next slide, what we'll do is we'll just cover in sort of headline terms really what's happening on the in this case the top right hand portion of the slide. So I'll just talk a little bit about sort of point 2 and point 3, and then I'll hand over to Daryl, who will cover the bit around point 4. And then beyond this, Phil will then jump in and talk about what's happening on the left-hand side of the slide. But in essence, it's pretty straightforward. Intero takes receipt of funds from the liquidity pool, and we've got mechanisms in place that are doing that today. And Phil already mentioned that we've already got liquidity out in the marketplace and have executed transactions, which is really good news and very exciting as a first in this ecosystem. So we take control of that liquidity, and then we work with a series of originators across the US, multiple originators, so multiple origination channels. Some of our originating partners are some of the largest ERC originators in the US, which is very exciting for us because it means that we have an ever increasing sort of scaling of eligible applicants who are being presented to us. And what we do is we work with those originators who essentially have a backbone that is underpinned by CPAs and tax advisors and so forth, doing all of the tax processing work that really is the sort of front end bit that sees the applicants applying to the IRS and submitting submissions for tax credits. Once that work is done, those applicants are introduced to us. We take charge of the tax credit packs, and then we engage with those applicants from an underwriting perspective. And we assess not just their eligibility on the basis of what the CPAs and tax advisors have done, but also in terms of our willingness and desire to provide them with advanced funding offers. And in that particular case, if we decide to take them forward, then we essentially move down into the area of point 4, and I'll hand it to Daryl for that.
Yes, so as Tom described, it's essentially a two-phase process, one dealing with the origination of the submission and then moving on to the funding of the advance, which is what we focus on. So our process is more about confirming what the originators have done in terms of the preparation and submission to the IRS. We don't look to re-perform their work. Following that, we apply sort of the more traditional credits underwriting approach to each applicant, and combined, we end up with a holistic view of the applicant, their organization, sort of their past, how they got to where they are today, and then looking forward to what sort of their behavior might be down the line in order to execute transactions that are reflective of the risk profile of the program. With all of that, once the funds have been deployed or advanced to the applicant, we essentially trigger our monitoring program. And this kicks in during the transaction execution phase. So we combine things like tried and tested mitigants, UCC1 filing, statutory monitoring, monitoring for changes of address, changes of business activities, even bankruptcy, the more traditional things that you would look for when lending, even though this is not a lending program. And then we combine that as well with more technology-based solutions. A lot of innovation has come out in the sort of IRS space as well, with getting view into what goes on behind the scenes there. And it gives us insights into what might be happening next with regards to the issuance of that check, coming finally into the escrow to settle the entire transaction structure, monitoring the applicant on an ongoing basis while that receivable is outstanding, and then finally ensuring that the funds make their way back through on-chain into the liquidity pool.
Great, thanks guys. And on the AQRU side, I think we have a little bit about that. Next slide.
Yeah, so this is pretty simple, but this is where the lender essentially just connects their wallet to the Maple Finance app, and they would then just deposit funds. It's a very, very simple process. There's a bit of work to do before that. Everyone who's involved in this pool gets KYC'd. And once you're KYC'd, we'll whitelist your wallet address. That enables you then to interact and deposit into the pool. I think it's just worth highlighting that this was something a lot of our customers were asking for, given what's been happening with CeFi apps, especially CeFi lenders and exchanges, and kind of the counterparty risk that goes with this. Having something whereby you can just connect your own wallet infrastructure, your own custody, you're not having to give it to a third party in essence, was incredibly attractive. So that's something that we've actually found, especially with people already involved in the crypto space and have been generating yield previously. They thought that was quite a nice value add for this kind of operational flow.
Next slide, please, Martin. Yeah, so I think Phil summarized it up there. With AQRU's role as manager of the pool, and I think that concludes the content for our presentation. But I know we have a number of questions coming in that we'll turn to. But just broadly, if anybody has additional questions and would like to explore the opportunity further, please visit the app maple.finance. You can complete lender onboarding here and find a link to contact us and have a representative from the Maple and AQRU teams reach out and answer any further questions you might have. So switching to the questions now, we had one from Nils, who mentioned the submissions are complex. And question for Intero: how are you able to evaluate if a submission is valid and likely to result in a payout?
Yeah, so that's a fundamental question around the submission itself. So there's essentially two qualifying criteria around the submission of the refund. One is based on a decline in gross receipts during the 2020-21 period. The other one is impact through to, say, shutdown orders. So in the case of decline of gross receipts, it's a relatively straightforward objective analysis of the financials of the entity. Did that reduction in revenue meet the qualifying criteria? And if so, how did it sort of play out over that qualifying period itself? So that's the objective decline in gross receipts. On the other side, there is, while it can be objective, it is slightly more subjective as well, where let's say, for example, there was a government mandate to shut down. So right at the beginning of the COVID period, as we all know, that was sort of the broad-based approach to handling the pandemic in itself. Everyone sort of stay at home, don't go out there, businesses had to close. So with all of that, you would qualify the applicant by lining up what their scenario played out in, looking back, 2 years ago or so, and then tying those up to the mandates, the orders that came out of the government. So sort of on a federal or state level and so on. And that's where some subjectivity can come into it, because while you have the direct connection between a mandate to shut your business down, there are also some sort of secondary effects of it with supply chain impacts. Let's say, for example, you're a business that imports goods and your operations are dependent on being able to receive those goods and then sell them into a marketplace. If there were supply chain disruptions, port closures, you've got sort of the secondary effect that then applies to it. So during our process of confirming what the preparers, our originators, have done, we look to align all of that. So again, not reperforming it, but just making sure that in the case of declining gross receipts, the math checks out. And in the case of, full or partial suspension of operations, that the motivation makes sense, that it's not too loose, it's not a reach, but there was direct impact.
And I think, one of the really important points that Daryl raises here is it's the partnering arrangements that we have. So we work hand in glove with the originators that we've already described, CPAs and tax advisory firms, and so they are doing some really good diligent work around the status of those entities through the 2020 and 2021 period, everything that has happened from a tax reporting perspective between that period and now, and we make sure that we have multiple eyes on each one of these applications through various funding partners to ensure that nothing falls between the cracks.
This is quite an interesting part of all of this, because as you're mentioning there, it's that application risk, which is what you guys are really trying to mitigate, versus where some other strategies where there's a direct lending element to the end user. That's what's not happening here. It's a sale and purchase, which is very different kind of risk profile, which I think is quite attractive.
Yeah, and actually what we're finding in the marketplace is that there are some lenders out there who are looking to, increasingly get involved in this particular program. But the feedback that we're getting through our originators, some of whom do deal with lending as well as receivables purchase, is that by and large, most of the applicants are looking for something that's a sort of clean cut process, so that they don't have this kind of lingering attachment to their balance sheet or credit scoring through various loan systems that are out there. So the receivables purchase, sale and purchase agreement is pretty exciting for a lot of these applicants.
Yeah, that's a great question, Nils, and really boils down to, I know Phil at AQRU, you and the team spent a lot of time underwriting and diligencing the strategy, and the biggest risks I think identified are, that the tax credit application is invalid, which if Daryl and Tom talked to how you ensure that the applicant applies for the credit via the objective versus subjective criteria. And then I think the other one, Nils, that you pointed out is if the business that you purchase the receivable from becomes insolvent, is the receivable still good? So maybe highlighting that one a little bit more.
So in the event of insolvency, as with any other receivable, it is still a debt to be received by the company, right? So it would follow a normal sort of bankruptcy process itself. So we look to secure ourselves in the transaction, again, using things like UCC1 filings and so on, so that in the event of insolvency, bankruptcy, the receivable itself is still realizable. So the IRS essentially has an obligation to issue that refund one way or another, whether the company's insolvent or not, provided that, timelines and so on were met. So really there's no risk as maybe would be attached with sort of the traditional lending structure itself. I see there's a sort of follow-up question there around the KYC and AML that ties into this as well. So that again is where the traditional side of our experience, our background, absolutely there is a KYC AML process that's involved in this. We do vet the applicants, the companies. We do run them through a process that addresses all those traditional concerns itself. And there are instances where we may not move forward with the transaction if it doesn't meet our criteria.
And of course, the other thing is, as we've already described, we take charge of the checks at the back end through escrow. So, in the case of a bankruptcy, that's, potentially when, we have, if you like, hands on, the proceeds of the receivable, and then we can distribute accordingly based upon the sale and purchase contract and all the various, mechanisms and clauses that are associated with that.
Yeah. That's a great point. All of the underlying receivables that serve as collateral securing the lenders in this pool sit in escrow accounts and receive the payments directly from the IRS.
Correct.
Well, I think we're approaching the 30-minute mark. I really appreciate everyone's time today, Phil, Daryl, Tom, and everyone who joined us, and good questions and productive discussion. I encourage everyone to reach out. Martin just pasted the onboarding link there. If you sign up, we'll get your information. We'll get in contact, run you through the KYC and lender onboarding process. Right now, we're guiding towards $250K minimum deposit size, and all lenders into the pool are KYC and onboarded via the Maple application. So thanks again, everybody. Please reach out. We're looking forward to this and scaling it over the coming months. And I know, Michael, you had another question about other products. Maybe we'll save that for the next call, but there's definitely some interesting ones down the pipeline. Tom and Daryl have significant backgrounds in trade and supply chain finance, receivables. So be on the lookout for future developments.
There are other products. Yeah.
Great. Thanks, everybody.
Thanks all.
Thank you.